first question. Okay. Is the system clean? Are you in a position to see that? Okay. So you are in a position to see my screen. Good. So the first question goes like this. Why do pensions and other security payments get excluded while calculating national income? So please note that national income, correct? We can compute it in multiple ways. Okay. It may be an income method, expenditure method, or value added method. Those things you would have already tried. So now comes the most important thing. Where do this pension and other security payments would normally come in? Whether it is an expenditure one or an income one, because there is nothing called as value addition here, because there is no value addition which would happen for this. Number one, for paying pension, there is nothing we are going to get. For the services already rendered, now the people are getting the pension. Similarly, if you look into the other security payments, for instance, various state governments are having something like subsidized food or subsidized medical facility, etc. Those are all security payments. And if you look into that, whether there is going to be any specific service or any specific value addition there, the answer is clearly no. So this is one of the reasons why we predominantly do not compute pension and other security payments while computing the national income. Any doubts here, team? Any explanations you want? So in case if you are having any doubts, you can chat also, I could see. So understood. Thanks, Akhilesh. And if you look into the specific explanation given here also, it goes like this. GDP measures which is produced or created over the current time period and excludes all non-production transactions. So it is very clear that they are considering this particular payments, which are pension and other security payments, as a non-production transaction, because you cannot directly correlate with any of the benefit which the society can derive. So only the incomes which are earned by the owners of primary factors of production for service rendered in production are included in the national income. So it is very clear. So if there is any benefit which the nation is going to derive, those expenditure we will certainly include as part of our national income. But please note that even this cost, whatever we are making, is actually the expenditure in that particular economy. This is also one of the reasons why normally government wanted to increase the DA for government service, so that can put more disposable income in the hands of the general public. Because what would happen is that even if they are increasing only for the government servants, only 10 lakh people will get benefit. But at the same time, the 10 lakh people is part of the overall society, correct? They will in turn spend that further with respect to the specific expenses which would go to some other person. So the money multiplier concept will kick in. So that is the reason why the government wanted to increase the salary or the amount in hand of the government service, which would in turn pay the way for spending more in the economy. So the transfer payments, which is whether it is from a private or government or made without goods or services being received in return. So those are not considered in the national income, despite that it creates some credit facility and money multiplier concept. These payments do not correspond to return for contribution to production because they do not directly absorb resources or create output. For a pension, or if you look specifically into any social benefit, the amount spent, there are some expenditure which are happening, credit facility is happening, but at the same time, is there a tangible output which has been created? The answer is no. But intangibly, yes, there are a lot of benefits which are available for the societies, but unfortunately, that we are not considering in the computation of national income. Therefore, transfer income such as pension and other social security payments clearly excluded from national income. So we all know that the national income can be computed in three parts. The first one is relating to income method. The second one is relating to expenditure method. The third one is relating to value added method. In all the three methods, we will not consider these two things, that is pensions and other social security payments. Any doubts here? Shall I proceed, or somebody wanted me to explain on the concepts relating to the computation of national income? So the second question goes like this. Okay, here there is a computation related problem. So they have provided the details like this. Calculate liquidity aggregate L2 when the following information is given. So they have given a vast number of details. They are speaking about term deposits with term lending institution as 750 crores, term borrowing by refinancing institutions at around say 450 crores, all deposits with post office savings bank at around say 1,000, and term deposits with refinancing institutions which comes crores. And there is something called a certificate of deposits issued by financial institutions which constitute, and then we are also having public deposits of non-banking financial company NM3, that is new measure 3, which constitute 2,650 crores. And finally, we are also having something called as national savings certificates, which constitutes around say 240 crores. Please note that this is not based on what is the actual data available with our economy. It is only for the purpose of computation here. So how many of you know about the various monetary measures our country is having? Anybody wanted to tell about that? There are three methods in which we normally have. One is the M0 to M4, the another one new measure, NM1, NM2, NM3, etc. And the final is about the liquidity measure. And the question here is about the liquidity measure here. Trust you have already covered that. Do you want me to specifically explain about that, or shall we directly go into solving this particular question? Anybody, you can even chat. You can provide your update in the chat so that I can read through that and help you out in case if you want some explanations.
Sir, sorry for interruption. Students, kindly make this live session as an interactive session, so this live session will go good. Okay.
Kamlesh, I think we lost you in between.
Sorry, sir?
Okay, just what Kamlesh was trying to tell you is that try to make this session more interactive so that it is fine for you to have additional knowledge, whatever you want to have, and make use of the available resources here. So I could see there are 3 more resources who have joined. Ikra has joined and Manasi has joined. So in case if you have some doubts, okay, you may please ask your questions either by unmuting yourself or by using the chat functionality here. Right? So we are in the second question now, and I just want to check with you whether you are aware of that 3 types of measure concept, that is M0 to M4, and then new measure NM1 to NM4, and then finally we are having the liquidity measures. Okay, are we aware of that? So I will just give you a brief background again relating to the measure concept. This came in the year 1935 when the RBA Act came into picture. And predominantly, M1 is something which speaks about the currency notes and coins with people, along with demand deposits with the banking system, both current as well as savings deposits, plus other deposits with Reserve Bank of India. Reserve Bank of India, who can have the account? Only the banker. Okay, because it is only a banker's bank, so public directly cannot have any money deposited with RBA. So M1 constitutes that. It is the basic currency notes and coins which are circulating with the people, plus the demand deposits. That is on demand, they can go to the bank and get the money. So either in form of current or savings accounts, plus the bankers will have some money with the RBA. That constitutes the measure 1, M1 money. And then next comes the measure to money, the one which we have explained in M1. Along with that, savings deposits with post office savings bank account. That is across various cities in India, cities as well as villages as well as towns. There are a lot of post offices. There we can open savings bank account, and a lot of people have actually have their accounts with the post office savings bank. Okay, so that money is also considered. The third one is that measure 3, which is equal to M2, whatever we have explained now, plus time deposits with banking system. Okay, and more importantly, the reason why now we have added the time deposits with the banking system is that whenever you wanted to pre-close a particular time deposit, it is feasible. So even though we know that we are going to get that deposit, say after 3 months, after 6 months, etc. If you are ready to take up a penalty, you can take that particular money immediately. Okay, good, Manasi. There is a question from you, sir. What is M1 and M2? The M1 and M2 are nothing but measure 1 and measure 2 as defined by the Reserve Bank of India. As I have pointed out, it started in the year 1935 when we had the Reserve Bank of India Act, and in that they have clearly defined about the measures, okay, of money in circulation with the society. So M1 is nothing but a very narrow money which actually speaks about actual money in hand with the public in form of currency notes or coins, plus their savings bank account or current account, which they can use immediately, plus bankers bank, right? RBA, they are having the bank, they are having some money from the respective banks. That money, that constitutes M1. And of the post offices, right? That M2. Along with that, if you are just adding the time deposits with the banking system, that constitutes the M3. And finally, M4. M4 means M3 plus the total deposits with the post office savings organization, except, okay, national savings certificate. You can notice that in the question also, they have given something called as national savings certificates, which clearly means that in the measure concept, it is actually removed. So this is one of the things up to M4, which the RBA has provided based on the liquidity. But over a period of time, this is not in a position to explain the actual money liquidity. So the Reserve Bank of India, during the year 1992, with a working group, 1998, sorry, it is in the year 1998, there was a working group of money, and they started publishing new monetary aggregates. So instead of M, they used NM. NM stands for new monetary aggregates. Again, they have told us that NM1, NM2, NM3. Okay, now in the new measure, some tweaks. For instance, that any currency in circulation, okay, plus bankers deposit in circulation means in the people's hand, plus bankers deposits with RBA and other deposits with RBA. Now in this, they are clearly telling that, you know what, it is not only banker who is having it. We all now know that so SGB, sovereign gold bonds, it is directly actually held with Reserve Bank of India, correct, by the general public. So it is easy for us to apply. Of course, we have to apply either through post office, designated post office, or any public sector bank or a private sector bank. But at the same time, it is not the public, it is not the bank which is going to provide us a certificate. It is the RBA which is going to provide us a certificate, because they are all sovereign bonds. So they are covering that also in the NM0, which is nothing but the reserve money. In NM1, that is the next measure, which has additional liquidity, currency with public plus demand deposits with banking system plus other deposits with RBA. So it is not only bank, but also the other deposits also they are considering. And then NM2, that provides NM1, whatever we have defined right now, plus short-term deposits of residents, including and up to contractual maturity of 1 year. So which means that any deposit which the public is having with bank, which are to be matured within 1 year, or at demand they can get it. So those are, they are considering it as a new money aggregate too. Now comes the final one. NM3, which is new money aggregate 3. So that is nothing but NM2 plus long-term time deposits of residents, which means that if you're having a 3-year deposit or 5-year deposit with bank, even that they are taking. In addition to that, there are various financial institutions, right, who are having call or term money from the various people. So that also they are considering. That constitutes the NM3, which means that that's a maximum money we can have in a system, which means that that is considering your short-term money, that is existing available reserve money, short-term money plus long-term money, all considered there. Now, having arrived at this, in addition to the new monetary estimate, the Reserve Bank of India wanted to speak about liquidity. Okay, so they are telling that L1, L2, and 3, that is liquidity 1, liquidity 2, and liquidity 3. So now the L1 stands for NM3, whatever money which are computed with the new monetary aggregate 3, plus all deposits with post office savings bank, excluding national savings certificate. That is the 240 crores, right? That we should never ever include. Okay, why we should never ever include that? That is a special scheme whereby this cannot be attached for any expenses. That is a direct sovereign guarantee provided by Government of India. So they are specifically excluding that. Next comes the liquidity to L2. L1, whatever we have defined it till now, which is what we are going to compute here, plus term deposits with term lending institutions and refinancing institution. That is all financial institutions like NABARD, IFCA. So whatever they are having as deposits, even that we are considering, plus term borrowing by financial institution, plus certificate of deposits issued by financial institutions. Please note that here they are defining it as a financial institution, which means that even deposits with the NBFC is included here. Whereas in the old measures, it was not included. Now they are telling that, you know what, even NBFCs I am taking, cooperatives I am taking. So wherever I am seeing money, I will try to aggregate it here. This is what they are telling. And finally, L3. L3 is nothing but L2, whatever we have defined till now, plus public deposits of NBFC. Okay, which means that public would put some money in the NBFC, right? NBFC means Sundaram Financial Institution or any other mutual benefit funds. Okay, where people are putting their money. So if you are having something like a public deposit, even that they are considering, this is L3. But please note that for this particular question, we are going to discuss about L2. So which means is that whatever we have defined right now, right? First we have to compute L1. Okay, for computing L1, we have to compute NM3. So once NM3 we have to compute, then we have to compute NM2 and NM1. So what we have to see, we are already having something called as NM3 already computed and provided here. So 2,650 crores is already given to us. Okay, so we have to first compute L1 only because NM3 is already provided 2,650 crores and we have to compute L1. So L1 is nothing but NM3 plus all deposits with post office savings bank excluding national savings certificate. National savings certificate is already here separate 240. Do we have something called as post office savings bank? So here they have provided, okay, 1,320 crores. So this plus this, if we add, then we will get L1. So what is the answer we are going to get for that? Okay, anybody having calculator? Or otherwise, let me try my calculator. So we are having 265 3910. That is our L1. Now 3970. Very good, Neil. Okay, so this definition is very clear now. So we have already arrived at something called as L1. Now comes something called as L2, which is the question here. So this step, if you are completing this particular step, you will get 1 mark. Predominantly, this will come in a 3-mark question. So now you have already got 1 mark because your first step is right. Now you have to define L2. L2 is nothing but your L1 plus term deposits with term lending institutions and refinancing institutions plus term borrowing by financial institution plus certificate of deposit issued by FIS. So here we have to consider this 750 crores because term deposits with term lending institution, and then term borrowing by refinancing institution is also we have to consider, and then term deposits with refinancing institutions, that also we have to consider, and then certificate of deposits issued by FIS, that we have to consider because that is also they are telling, and then public deposits of non-banking financial companies. This is considered only in L3 and not here. So only in L3 we will consider the public deposits non-banking financial companies. NM3 we have already considered for computing the L1, and finally national savings certificates. In all the definitions, we should never take this. That is, this L1 itself is excluding the national savings certificate. So this 240 crores we should never take. So whatever we have arrived, 2650 plus 1320, and that we have to add 750, 450, 590, and then 290. So we will see the answer once again. So this is the first one, which we have clearly defined. So L2 equal to L1 plus term deposits with term lending institution plus term deposits with refinancing institution plus term borrowing by refinancing institution plus certificate of deposits issued by FIS, financial institution. So this is the one which we have already computed, 3970 crores. With that L2, 3970 plus 750 plus 590 plus 490 plus 290. What are the things we have not taken here? We have not taken that 450 and 240 because the definition does not cover that. So that gives you an answer of. So now let us go to the next question. So next question speaks about how is the behavior of central bank in economy reflected, explained. We all know that what is meant by a central bank. Central bank is nothing but banker to the government, and it is the bankers bank. They are the lender of last resort for any banking issues. And there are two kinds of policies. One is the fiscal policy, which is given by the government, and another one is the monetary policy, which are predominantly implemented by the central bank of any country. For India, the central bank is Reserve Bank of India, right? They act as a bankers bank, and they act as a banker to the government also. Nowadays, even the sovereign guaranteed bonds, RBI is responsible, and slowly it is not only they are acting as a banker to the government, even with the public, only for the direct investment or borrowings of the government, they are giving that sovereign guarantee. For that, they are directly reaching out to the investors also. So if you are having a 10 lakh rupees, you can directly invest in RBI bonds, which is possible now. Very recently, they made it possible, not prior to that, because before that, public cannot directly go and invest with RBI. Presently, that window is open. You have to have a user ID and password. Of course, you need to have Aadhaar and PAN card mapped, and you need to have PAN card. There is a proper registration process, etc., available in the RBI website, through which only you can invest in those. So now, we all know that Reserve Bank of India is our central bank. So how Reserve Bank of India is actually affecting the banking system? They just ensure that on a quarterly basis, they are either increasing or retaining or decreasing the interest rate, that is bank rate, right? When the interest rates are increased, which means that every people will put the money in Reserve Bank instead of lending, and the interest rate for lending will increase, and slowly the money would be squeezed out of the economic system. Okay, in case if they are reducing the bank rates, what would happen? The bankers will do not want to keep their money with the Reserve Bank of India. They want to invest with the people because they are having more money with them. So they are trying to reduce the interest rate, and whereby they will pump the money in the economic system. So if there is something called as hawkish policy, etc., which means that I will try to reduce my interest rate so that I can ensure that the market has more credit facility available. So that is how the central bank normally tries to do. In addition to that, central bank is also interested in something called as stabilization of the country's currency globally. For instance, suddenly there is a great demand for US dollar. So what RBI will do? RBI will start selling whatever dollars they are having. Similarly, they are noticing that various banks are having lot of forex reserves with them. Suddenly, they will start buying it from the market. So that kind of operations is also done by central bank. Do you have any specific questions relating to the performance of Reserve Bank of India? Any specific question you want me to cover? Anything specifically you want to cover? Yeah, I'm seeing a chat there. No. Okay. So which means that for us, the role of RBI, number one, they act as a banker to the government. Number two, they helps in formulating policies for our financial system. As I have explained you, it is about increasing the bank rate or maintaining the bank rate or decreasing the bank rate, etc. They helps in foreign exchange management. They ensure that rupee is not much appreciation, rupee is not much depreciated against any particular currency. They act as bankers bank, that is any money, whatever the bankers are having, but up to 26% as an SLR they have to maintain with the central bank, that is Reserve Bank of India. And they have one great thing with them. So with the support of finance minister, they can go ahead and print new notes. That's one advantage. They act as an issuer of currency, and then they support in monetary policy. Fiscal policy is governed by the elected government, but monetary policy, it is the Reserve Bank of India which is doing. And so these are the primary areas which they normally cover. So their behavior is also dependent upon these functions only. Let us look into the points given in this presentation. Excuse me. The behavior of central bank, which controls the issue of currency, is reflected in the supply of the nominal high-powered money. So what is this nominal high-powered money? See, please note that any currency, it will have a demand provided there is a demand for the particular currency. For instance, if our money is appreciating against dollar, which means that for a lesser number of Indian rupee, we are going to get more number of US dollars. Okay, and similarly, if we wanted to have more exports, naturally we will try to depreciate our currency, which means that for more number of Indian rupee, we will have less number of US dollar or any other currency, which whatever we are planning to offset there. So that is nothing but nominal high-powered money in relation to some other country's currency. When we are comparing or when we are pegging our currency, that gives the reflection of the supply of the nominal high-powered money. And then money stock is determined by money multiplier, and the monetary base is controlled by the monetary authority. So here the word very clearly explaining about money multiplier, which means that if RBI is actually printing, say, $1 million rupee notes, it is not that it is going to give a credit of only exactly 1 million. Okay, because what would happen? It would change hands. When it is changing hands, it will create additional credit. For instance, if you are going to give me, say, 10 rupees, I am having 10 rupees now. So the first transaction is 10 rupees. And after that, what I am going to do, I am going to have the 10 rupees. I am going to put some 2 rupees in my bank and 8 rupees I am going to spend. So which means that in the system, again, I am giving this 10 rupees back. So which means that 8 rupee out of that 10 rupee given to me, 8 rupees back to the system. So which means that now 18 rupees is there in the system. The other person who has received the money from me, they will again try to spend. So like that, the money multiplier will actually happen. But what is the actual money there? It is actually the first given 10 rupee to me, right? That was the initial money. Other things are nothing but the multiplier created because of the credit mechanism in our system. So if the behavior of the public and commercial banks remains unchanged over a period of time, the total supply of nominal money in the economy will vary directly with the supply of nominal high-powered money issued by the central bank. So the nominal high-powered money is nothing but the total money printed and issued by the Reserve Bank of India in concurrence with the finance minister. and thereby ensuring that we are actually having sufficient currency for the money circulation. That is, the economy has to run. The economy would run only with money, right? And for that, there has to be a proper credit multiplier. And for creating that credit multiplier, money has to be put into the system. So the responsibility of central bank is primarily towards that. And how they are trying to do that, they are having some 6 functions. It's starting with banker to the government and the bankers bank. They are also having a supervisory role of the financial systems, and they manage the forex, and they ensure that they are issuing the currency, that is, they are printing the rupee notes, and finally they ensure that appropriate monetary policy is put in place. So these are the 6 areas through which our Reserve Bank of India is helping to ensure supply of nominal high-powered money, which means that a money which has a respect with over. Thank you. Let me go to the next question. So here we are having a very interesting problem what they have provided. Of course, if you look into this particular problem, it's one of the easiest thing to do, because there is no need for us to work on the problem itself, because it is so simple that we can directly tell the answer here. But we have also provided how normally you have to approach it. It normally comes in either a 2-mark question or a 3-mark question, predominantly in a 2-mark question. So the question goes like this. Countries Roseland and Daisyland have a total of 4,000 hours each of labor each day to produce shirts and trousers. So what is the limiting factor here? The limiting factor is the availability of hours, which is pegged at 4,000 hours each for both the countries, Roseland as well as Daisyland. Both the countries use equal number of hours on each good each day. So which means is that both of them, if one country is working for 8 hours, other country. The third point is that Roseland produces 800 shirts and 500 trousers per day. Daisyland produces 500 shirts and 250 trousers per day. The interesting thing, when you are comparing itself, Roseland is producing more shirts, Roseland is producing more trousers also. So naturally, if you look into the question, in the absence of trade, that is, the trading is not there, which country has the absolute advantage in producing shirts or trousers? Whatever it is Roseland, because they are producing more shirts, they are producing more trousers, correct? And then next comes, which country has the comparative advantage in producing shirts or trousers? If you look into the comparative advantage, imagine a country can produce only shirts, a country can produce only trousers. Like that, if I am going to have, so if you are planning to have all the shirts, instead of this 250 trousers, can I make entire 500 shirts? And similarly, instead of that 800 shirts, can I make trousers there for Roseland? Like that, we have to compute. So for that, what we are planning to do, we are planning to introduce some variable. So if I'm not going to produce that, what is the opportunity cost? So once I know the opportunity cost, then I can answer for the comparative advantage. Normally, what would happen? So I can produce more shirts, right? So Daisyland can produce comparatively more shirts, because when Roseland is producing 2 trousers, they are producing only one. Whereas when Roseland is producing, say, 5 shirts, they can produce how many shirts? 10. Okay, so if you look into this 800 shirts, and they will use for 4,000, they can have 5. When they are using 5 hours, 4,000 shirts they can do, but they have to do some 10 times. So which means that almost twice they have to do for the same thing. So here also Roseland is having an edge. Now let us go through the workings to represent how we can answer for this. Please note that this is only a 2-mark question. So already we have answered for the first one. The second one, normally that would be for 2 marks. That is the first one, 1 mark. You can easily get that, because the comparative advantage is always with the Roseland. Only for the second one, we have to put some additional workings, which is nothing but about the opportunity cost of, instead of preparing shirt, what if a trouser has been prepared? And if you want additional production, whether you will go with the Roseland or you will go with Daisyland. So that is the question here. So the answer goes like this. Of course, the first one, I do not want to explain that. you can naturally see that the number of shirts produced by Roseland is higher as compared to Daisyland, and trouser is also higher as compared to Daisyland. So considering that, Roseland is actually having the benefit. Okay, so if you look into the other one, okay, how the number of hours they are spending, so that we can arrive by this. Okay, what is the total number of hours which are available? And there are 4,000. Each country has 4,000 hours of labor, and they are actually producing it equally. That is, they are using 2,000 hours for producing shirts and 2,000 hours for producing trousers. So what is the number of hours spent per unit on each good? So 2,000 divided by 800 gives you 2.5. Similarly, 2,000 divided by 500 gives you 4. And 2,000 divided by 500 gives you 4. And then again, 2,000 divided by 250 gives you 8. So this is the first level of computation what we are having. So at this point in time, it is very clear that the absolute advantage in both shirts and trousers are with Roseland. So Daisyland is not great. Roseland is great with respect to this particular question. This is the answer for the first one. Any doubts here? Shall we proceed to the next one because it has some complication? Shall we proceed to the next one? The second part of the question?
Yes.
Perfect. Yeah. So the second part goes like this, the comparative advantage, which means that instead of this, or if I am going to have some additional demand, which country I have to go and use that. Okay, so here comes the opportunity cost. The opportunity cost for Roseland, if you look into the shirts, it is 2.5 divided by, which is equal to 0.625. How come it comes? It comes from here. 2.5 divided by 4, because using trousers, they can opt for trousers like that. Similarly, the opportunity for cost of trousers, just put that in the reverse, 4 divided by 2.5, which gives you 1.6. And then comes Daisyland. Again, here also, you have to put 4 divided by 8, which is equal to 0.5, whereas 8 divided by 4, which gives you 2, which means that for if you wanted to stop trouser, we are going to have additional hours available. So because maximum time is spent on producing trousers by both the countries. Now, for producing shirts, Daisyland has lower opportunity for producing shirts. Therefore, Daisyland has comparative advantage because see here, if you look into this, Daisyland, they are having, they can produce more shirts here. 0.5 as compared to 0.625. So they can produce more. So that is one of the advantage they are having when they are not producing trousers, but they are producing shirts. And then for producing trousers, Roseland has lower opportunity cost for producing trousers. Therefore, Roseland has a comparative advantage. So if you look here, so we look into the Roseland, that is 1.6, which is lesser than 2. So which is one of the reasons they have the comparative advantage. So this computation is more important. This comparison, 0.5 is lesser than 0.625. So Daisyland is having comparative advantage. Similarly, if you look into this, 1.6 is lesser than 2. So Roseland is having the comparative advantage. So now comes the question number 5, the last one, which has been selected by our team, backend team. Calculate national income by expenditure method and income method with the help of following data. Remember, there are 3 types of computation which is possible. One is expenditure method and another is income method. The third one is value added method. So the present question does not speak about value added method. It speaks only about income method and expenditure method. Ideally, if other things being equal, the answer for both should be one and the same. But in the real world, the data may not be available. So it is not that it has to be same. Same is the case with our problem also. Whatever that data which is available here, we will just try to apply our formula there. When we are applying the formula, what we will get? We will get an answer. Okay, that may or may not be the same in both the methods. But in the real world, ideally speaking, in the idealistic world, whether you are going by expenditure method or you are going by income method or you are going by a non-value added method, Ideally, we have to get the same or similar answer, but in the real world, it is not so true. Okay, there may be some data which are a bit different, and because of that, there is a chance that we may land up in a different answer also. So here, the data provided are compensation of employees, which are given as 1,000 crores, and then net factor from abroad. So compensation for employees. Now you tell me whether it is going to be used in an expenditure method or an income method.
Expenditure, sir.
No, ma, it is actually an income. Income compensation for an employee is income for a people. Okay. For instance, people are working in government, or I am working in some, or you are going to work in some company, receiving the money, right? Ideally, it is an expense for the particular company, but it is an income for us. So compensation of employees, normally we will treat it as an income method. Okay, in the expenditure method, it would come in a different method. That is, they will treat it as an overall consumption expenditure. Okay, so for our particular purpose question, we will consider this in compensation of employees in income method. Okay.
Okay, sir.
Got it? Yeah. Okay. Net factor income from abroad, whether it would come in expenditure method or income method. Ideally, it would come in both the methods. Okay. This, if you look into this particular 20, it would come in NFIA, they will call it as net factor income from abroad. That is considered, that is added in both income method as well as in expenditure method. So it is an amount which our company, which our country is benefited based on the persons who are residing there and they are working and remitting it to India. So that is a net factor income from abroad, either for the services rendered outside or for our products which are sold outside. When we are receiving some money, that is considered here. So be it an expenditure method or an income method, we will consider this. Next comes the indirect taxes. Indirect taxes is actually, then as the name implies, we have to exclude this from expenditure, because the reason is that is an amount given to the government. So net indirect taxes, we normally remove it in expenditure method. So the next one is nothing but expenditure, removal from the expenditure. Next comes something called as profit, 800 crores. Whether this will come in expenditure method or in income method. Anything, any guesses will do.
Income.
It won't actually come in both, because profit is nothing but your excess of income, your profit. Similarly, if there is something called as excess of expenditure over income, then it is a loss. So both the things would not come in our computation actually with respect to the formulas we are having. So this net profit, whatever they have provided, this we have to ignore. Okay. So this will not come in the method or in the expenditure method. Next comes private final consumption expenditure as 2,000 crores. Whether it is an expenditure or an income method. Private final consumption expenditure. Any guesses, please? You may, because there are only two methods here, right? Tell me any one method. I will tell you whether it is right or wrong. I will also tell you why it is right or why it is wrong. Private final consumption expenditure as 2,000 crores, whether that has to be treated in income method or in expenditure method.
Expenditure.
Perfect. It is an expenditure method. So if you look into my explanation for compensation of employees, in compensation of employees, there we are speaking about good, Akhilesh. It is an expenditure method, correct? In the compensation of employees, it is more about from the viewpoint of employee, it is a receipt and we are considering it in the income method. Whereas here, they have clearly provided us private final consumption expenditure, which means that the total people who are spending there, right? Whatever the money they are spending, that is aggregated to 2,000 crore rupees. So that we have to consider in our expenditure method. And next comes the net domestic capital formation, 770 crores capital formation. So it is domestic savings here. Okay, net domestic capital formation, 770 crores, whether expenditure method or income method. So even some time before, I have told you some example in money multiplier concept. I will receive rupees. I will put 2 rupees into the bank and balance 8 rupees into the economy. That 2 rupees is nothing but I am somewhere actually providing capital formation only. So now you tell me that is my expenditure or income?
Income, sir.
Is my expenditure because I'm spending it out. What I have received, I'm just giving it to the banker 2 rupees and back to the society 8 rupees, right? So considering that I'm spending it. So domestic capital formation is also used in the expenditure method actually. And then comes the consumption of fixed capital. Consumption of fixed capital. Again, that is also forming part of capital formation
Sir, but
only.
capital
So
is
there are
form of
fixed capital
asset,
which are
sir.
available, which we are, sorry?
Capital is in the form of asset because we are going to invest on business.
Correct. We are going to invest on that. But do you think that the capital is going to be there or it is going to be spent further? It is going to be used, right? There is something called as depreciation which would come into picture, right?
Okay, sir.
So the consumption is there. See, for instance, I cannot have something as a capital and I cannot tell that I will not reduce it. Ending, I generate more money tomorrow. So that is where these two, 770 crores and 130 crores will come. One is the net domestic capital formation. Another is consumption of fixed capital. The capital is available and we are going to consume it. The final one is relating to the rent. Rent as a 400 crores, right? Now you tell me whether we have to consider that in the expenditure or in income or not in both. Actually, we will not consider that in any of them. The reason is that rent. Okay, are we going to create any asset? No, the answer is no, correct? We are going to just use the place and the place is already available. Okay, it is only a place utility which is happening there, and for that, we are not considering it for the definition of both expenditure method and the income method. Let me go to the balanced questions. Okay, and now they are also speaking something about interest. So for the capital so computed, so garnered over a period of time, not now, not only the previous year, we are paying, we are rewarding them with interest. Okay, are we considering that? Considering that in the income or expenditure method, when rent itself is not considered, even the interest, which is also a reward for one of the factors of production, will not happen there. So 620 crores we will not consider anywhere. Next comes mixed income of self-employed, 700 crores. Mixed income of self-employed, which means that there is a person who is an entrepreneur. Okay, self-employed here represents entrepreneur. And that person would be having some earned money, right? Okay, whether that is considered in an income or in an expenditure. Income of a self-employed who is an entrepreneur.
Income.
Sorry?
Income.
Right. Yeah, we have to consider that in the income method. Next comes the next exports. Okay, net exports is 30 crores here. We have to consider that in the expenditure or in the income. So it is actually an income, but we have to eliminate that from the GDP. Okay, so from the GDP, we will be eliminating the net export while computing the expenditure method of national income. Right? Any doubts there?
No, sir.
Perfect. So next comes the government final consumption expenditure. See here, I have to tell you two things here. Earlier, we have something called as private final consumption expenditure 2000 crores. Okay. Similarly, there is something called as government final consumption expenditure. We have considered that. What to do with the government final consumption expenditure? I have answered for this some time before. Why? Then when explaining the first question. Okay, government is spending money. Okay, they are spending money so that people can have more money and they can put more money into the economic system. So government final consumption expenditure, will that be included or not? If to be included, whether it is to be included in expenditure method or in income method.
Expenditure method.
Perfect. It is in the expenditure method because, as I have told you, we have to use the same method what we have told for private final consumption expenditure. And then comes something called as operational surplus, 1,820 crores. Operational surplus, which means is that excess of income over your expenditure while doing an economic activity. This is the operating surplus. Whether this needs to be considered in the income method or in the expenditure method, or should not be considered at all. Operating surplus.
Income method.
Yes, income method. The answer is right. We have to consider that in the income method. Next, this is also covered sometime before. Employees' contribution to social security scheme of 300 crores. There are two things which are not considered. One is the pension payment and another is the social security payment. So both the things should not be considered either in your expenditure method or in your income method. So let us see whether there are any further inputs for the question. No, it is directly going to the answer. Now see, we have already discussed on what needs to be considered, what should not be considered. We will just see whether it is in the same method or not. So first, for expenditure method, what we have to compute is the gross domestic product at market prices we have to consider. And then that is the first step. We have to post that, we have to consider NNP. That is the net national product at factor cost. That gives you the net income, okay, or the national income. Okay, here GDP at market price can be arrived as government final consumption expenditure plus government domestic capital formation. That capital formation of including two things, domestic capital formation plus depreciation plus net export. So we will see what are the things which we need to add here. So we need to add private final consumption, 2,000 crores. And then we also in need of government final consumption expenditure, 1,100 crores. And there is something called as the domestic capital formation, 770, and consumption of fixed capital, 130 we have to consider. And anything else in this page? No. NIFA, we have to consider it in the next step when we are computing the NNP. So nothing is available in this particular page. And then we are going to have something called as net export. Net exports needs to be included as a separate line item because they have given it 30 crores here. So what we have to do? So we have to add 2,000 plus 1,100, which gives you 3,100 plus 770 plus 130 gives you 800, 900. So which means 3,000, 4,000. So 2,000 plus 1,100 plus 1,000 gives you 2,000, 3,100, 3,100 plus 770 plus 900, 130 gives you 800, 900, 4,000. 4,000 crores plus we are also going to have this 30 crores. Okay, so 4,030 crores we need to have totally as our GDP at market prices. And then from here we have to deduct depreciation, add net factor income from abroad, which is already given, and then indirect taxes we have to exclude. So which means that out of this 4,030, we will first eliminate the depreciation component. Where is it available? Depreciation. depreciation is not provided at all. Okay, so depreciation is not provided at all wherever, nowhere it is available for us. And then we are also going to have here, what is that? Net factory income from abroad is there, which you can add. So 4,050, and then indirect taxes, which is already given here. There is indirect taxes. Net indirect taxes is again 120. So that they can eliminate. So here I am not seeing depreciation given here. Otherwise, we have to deduct depreciation also from this. Okay, so that is, let us see the answer here. So they are considering it 4,030 crores is there, and then GDP minus depreciation plus NFIA minus NIT. And they have given here in the answer as 130 per, but that detail is not available. So which means that 3930. So this question does not have the depreciation here. In case if they have given, we can have that particular answer, since that is not available. Okay, or they have defined this consumption of fixed capital as depreciation. So that is how they are actually interpreting consumption of fixed capital. They are actually considering it as depreciation, because depreciation is nothing but items which are actually used from your existing capital, right? So for instance, you are having ports, and then there is something called as bridges, dams, etc. And you are using it, and over a period of time, it is going to get depreciated. This is nothing but that. So that is the reason why they are considering 130 as depreciation, which is coming from the utilization of the capital expenditure. So that is the reason why they are excluding that 130 also. That gives us 3,800 crores. Now, ideally, even if you go by income method, that should somewhat correspond to 3,800 crores. But again, there is some variance. So the variance may not be more than 2% in the real sense. Okay. So if you look into this, NNP or NI, that is national income equal to compensation of employees plus operating surplus plus mixed income of the self-employed plus NFIA. It is straightforward, right? We all know that what is the compensation here. So compensation of employees is 1,200 crores, and we are having net factor income from abroad 20, that we need to add, and then we need to add, nothing is here, and then we can mixed income of self-employed 1,700 crores we have to add. Exports, it's not coming here. Expenditure 1,100 will not come here, and then operating surplus 1,820, it has to come here. Social security contribution we will not take. So considering that, so we are going to have 1,200 plus 20 plus 1,820 plus 700 gives you 3,740 crores. Just a cross check. 3,800 is what we have computed, right? On that, put 98%. 3,800 each equals 3,724. So since it is more than 3,724, which means is that, okay, we are almost there, because less than 2% is the variance we are seeing in both the methods, income method or the expenditure method. Ideally, if the details are clean, it would be same actually.